We're awaiting Trump's tariff announcement tomorrow. Our guest thinks the trade war will get worse before it gets better. What's the impact on the currency markets? We're joined now from Montreal by Harvinder Kalirai, a chief global fixed income and currency strategist at Alpine Macro. Thanks very much indeed for joining us, Harvinder.
Nice to be here.
Start off with the US dollar, would you? We have seen some pressure on the US currency. You think it's oversold?
Yes, that's more of a short-term technical assessment of where things stand. The dollar has been quite weak this year, falling against most currencies, maybe with the exception of the Canadian dollar. And that has just left it technically oversold. So we need to go through a period of consolidation or retracement before the bear market can resume. But right now we think that potential, say, counter-trend bounce is just going to be temporary.
Sorry, so give us that again. You think the US dollar is set to rebound, but it won't be long lasting?
Exactly. We just need to work off these oversold conditions. And as long as the fundamentals, which have turned bearish for the dollar this year, stay intact, then the cyclical bear market should resume.
Oh, in the US dollar. Is that because of massive US deficits?
It's a few things. First of all, it's the trade war. Despite what President Trump and his administration is saying, nobody is going to win from the trade war, including the U.S. So the U.S. economy is going to get hit by these tariffs, and that's going to lead to much weaker growth. And that's leading to a downward revision in expectations for Fed policy. So interest rates in the U.S. are not going to be as attractive as they would have been without the trade war. And secondly, policymakers around the world, in particular in Europe, are also responding to, a deterioration in relations with the U.S., both on the trade front and geopolitically. And the big game changer to us has been the announcement out of Germany, where they're going to be increasing infrastructure and defense spending quite significantly. That could add about 2 percentage points to German GDP for the next several years. So an economy that's been stagnant for nearly a decade is going to start to look a lot better. So that's what you're seeing, this shift in relative fundamentals. The U.S. is starting to look a lot worse because of the tariffs, and the fiscal response in the Eurozone is leading to an improvement in the outlook. And then separately, we have like the Bank of Japan, for example, that is setting its own direction and raising interest rates contrary to most of the other G10 central banks. So those are the two big currencies that the dollar trades against, the euro and the yen. And if those currencies are strengthening, by definition, the US dollar will have to be weakening.
Looking at the Canadian dollar, you think our bond yields are likely to come down and our currency is going to come under pressure in this trade war?
Well, obviously, it has already come under pressure. Bond yields have come down. The Bank of Canada has been the most aggressive central bank in cutting interest rates amongst the G10, and that's one of the reasons why the Canadian dollar has been quite weak. The markets are priced for another, say, 75 basis points of cuts this year. So it seems like a lot of news on the interest rate front has already happened and is also discounted going forward. So that could prevent significant weakness from here in the Canadian dollar. But again, that's not to say that the Canadian dollar is necessarily about to strengthen. We are going to feel the effects of the trade war here. And, we could be flirting with a recession as well. So that's not going to be very bullish for the currency.
Broadly speaking, you think bonds are a decent buy, I think, in multiple markets right now, because I guess you're anticipating partly that inflation is not going to be a severe problem.
Well, it could be a temporary problem, but that's the thing. Tariffs do not lead to a sustained rise in inflation. You could get a one-time increase in the price level. So that increases the inflation rates for, say, 1 year. But then a year later, those base effects work the other way around, and inflation comes down quite significantly. So at worst, it's a one-time increase in the price level. But more likely, because tariffs lead to much weaker growth, that's going to be very disinflationary. So it's going to be offsetting some of the inflation impulse that's coming from the trade war. Ultimately, if the economy does go into a recession, that will probably push inflation significantly lower, and that would be very bullish for bonds.
It's a really strange time, isn't it, when you think about it? when did we last see a trade war like this, or an overt one anyway?
We haven't seen this actually since the 1930s. And history shows us that that was a terrible time for the global economy. It was all started again with the U.S. with the Smoot-Hawley tariff. I think it was in the 1930s. That's how the U.S. was trying to respond to the Great Depression by, supporting domestic industry and keeping out imports. But what it led was for a tit-for-tat global trade war, and global trade collapsed. And that exacerbated the Great Depression. So yeah, this is something we haven't seen in nearly 100 years. So everybody's sort of flying blind, but the historical record is that this does not end well for the global economy.
I mean, there's always been a bit of hidden protectionism. I seem to remember decades ago, France dictated that all electronic imports had to come through Poitiers, some town, and there would be big delays. I mean, you do get, but Trump has been quite open about this thing.
Yeah, absolutely. There are always non-tariff barriers to trade, but generally the global economy has been becoming much more integrated, and global trade as a share of global GDP has been in a multi-decade uptrend, and that's benefited, significant part of the world. Free trade is the closest thing you can get to a free lunch in economics, and of course, moving away from that removes the benefits. So living standards, economic growth is going to be much weaker if these trade barriers are raised, and if it leads to a lot of back and forth retaliation.
Harvinder, thank you. And sorry, we've only about 20 seconds. Do you think there's a real risk that Trump announces more measures tomorrow, countries respond, and that antagonizes Trump and he'll escalate things from there?
Exactly. That's our thinking, that reciprocal tariffs are announced. There's going to be retaliation. That's going to infuriate the president, and then he might up the ante again. So we're going to be in this period over the next few months where we think it's going to be the maximum pain period. But then ultimately politicians will have to cave in. Once the economy is weakening, politicians will have to back off. So we see that happening possibly in the second half of the year. But first, we have to go through more pain.